Welcome everyone. My name is Matthew Thompson. I'm from Peregrine Capital, and today I'll be taking through our presentation, which is titled Cutting Correlation and How You Can Use Hedge Funds to Diversify Your Overall Portfolio. Peregrine Capital is South Africa's longest running hedge fund manager. Now these 5 key points that we've put on the slide really show who we are and how we can manage and why we should be managing your money. We're a boutique fund manager with a 25-year track record. Now, you don't get too many managers that are both boutique and with such long track records where you can really see how well we've done in a number of different market environments. We currently manage about 15 billion of investor money, which, although it sounds a lot, is actually fairly small in the context of South African managers, and we think that that size really gives us an edge in adding alpha to our portfolios. Very critically, we've had the same investment process since our inception. So for 25 years, while we've been managing money, the investment process is largely the same, although clearly is always refined around the edges. We really pride ourselves in having an industry-leading alignment of interests. What this means is that as the portfolio management team and the full company, all the employees at Peregrine Capital, have a significant amount of our own savings in the Peregrine Capital funds. So this means that when we think about managing your investments, we also think about managing our own investments. This is vital because it means that you can expect us not to take any significant risk that we wouldn't do with our own money, with your money. And as you can see from the awards at the bottom, we are one of South Africa's most successful hedge fund managers. At the top right of the slide, there are 2 very important points, something that we are very proud of. Our high growth fund is the first fund in South Africa to deliver over 100 times initial investments. At the moment, had you invested R1 million back when the fund started, you'd actually have over 138 million rand. And for the pure hedge fund, which is our low risk version of the fund, which we'll go through a bit later, that fund, since inception, has never had a negative year. So as you can see, both from a return perspective through the high growth fund and a risk perspective through the pure hedge fund, really 2 fantastic pieces of information that we are very proud of. As I mentioned those 2 funds, we really focus our offering through these 2 main funds. If we look at the high growth fund, it's a multi-asset hedge fund, and it really is aimed to deliver exceptional long-term returns. So you can think of this similar to our high equity balance fund, and that's who we like to compare ourselves to because the amount of risk that we take in this fund and the volatility is somewhere in line with those kinds of funds, but clearly we aim to achieve a higher return. The pure hedge fund, we like to think of as a low equity fund, a multi-asset fund. We manage it as a market-neutral hedge fund, so really an absolute return fund at a very, very low volatility. And as you can see there, 10-year volatility of 4.4%, and as I mentioned earlier, never had a negative year since inception. We really manage money on an absolute return mindset. And something that we like to say in the office is you can't eat relative performance, because we understand that as advisors or someone who needs to invest their money for a return, we like to give our investors positive returns regardless of the overall environment, something that I think very few investment professionals out there really strive to do when they focus purely on relative performance. So if we look at in 2022, those positive absolute returns were really hard to find, with the Nasdaq down almost 30% all the way up through to SA equities, which were broadly positive. And as you can see on the left-hand side of the slide, inflation being the highest return, although you can't exactly invest in inflation. What you could have invested in was the Peregrine Capital Pure Hedge and High Growth Funds, which you can see there in 2022, both gave double-digit returns, one of the few returns locally and I think globally to actually outperform inflation, which was significantly higher than a lot of investors expected. If we look to 2023, it really hasn't been much easier underneath the surface. So although overall market returns seem okay, there's been a lot of big names in the JSE that have really struggled. As you can see there, I'll just point out a couple. Sasol down over 12%, Exaro down 25%, you know, a number of these significantly drawing down in investors' portfolios. When we look at investments, we really focus not on overall sectors, but on underlying stock opportunities. We focus on bottom-up opportunities, and as you can see there, we've split 3 sectors: property, industrials, and financials. And if you just looked at the overall sector attribution for the year, you would have thought, okay, it's not too bad. But under the surface, there really is huge divergence. And if you have the ability, like we do as hedge fund managers, to own a share or short a share, so both make money on the upside and the downside, it's this kind of environment where you see these huge divergence in intra-sector performers that really give us the ability to make money in this kind of environment. Let's go deeper into some specific opportunities that we found in the last couple of years and currently, and specifically looking at pair trades. So now, what is a pair trade? A pair trade is buying something and shorting a share against it. So what this means is that regardless of what the market does, if our longs outperform our shorts, we'll make money for our investors. And it doesn't matter if the market goes down, up, or sideways. If our longs or the shares that we own outperform the shares that we short, we will create alpha for investors. Now, we like to do this on an intra-sector basis. So let's say that we have one company, let's say in the banking sector, we like one company, one bank, and we don't like another bank, and we think the one bank will outperform the other. We can buy the one and short the other. And regardless of what the banking sector does, and you know, we've seen over the last month or two how volatile South African banking shares have been, we can make money. And regardless of the overall direction of that sector, the ability for us to make alpha for our clients is quite clear. So I'll take you through a couple of examples of how we've done that. Let's talk a little bit about Bidcorp. So what is Bidcorp? Bidcorp is a food service operator. And you can see in the pie chart on the right-hand side, almost just over half of its revenue comes from the UK and Europe. It's largely a global player. They grew out of South African Bidvest, but really has proven themselves to be a leading global operator. So focusing on the UK and Europe, where the majority of its revenue, or more than 50% of its revenue lies. And then looking at the chart on the left-hand side, which is the natural gas, essentially the cost of energy in Europe. Now, last year, if we think about the year, I'm sure most of you will be aware that the cost of electricity and gas skyrocketed in Europe and the UK. And there were a lot of news articles, really a lot of fear-mongering and people getting worried about what this will do to the underlying consumer spend. So we did a lot of work to understand how much savings people still had coming out of COVID and how much consumer spending would be detracted from as a result of the Ukraine war and this electricity situation. So we did a lot of work, and we saw that actually consumer spending was remarkably resilient. There was a lot of COVID savings that had been built up on the side, and to be quite honest, a lot of people saw through this energy price shock, where they thought, okay, maybe prices will be higher for a little bit or a couple of months, but they will come down thereafter, and therefore didn't necessarily pull back aggressively on their discretionary spend. As you can see, what actually happened in H1 2022 and the second half of 2022 is Bidcorp's European revenue growth actually skyrocketed over 40%, 50% for that period. During that time, we had a long position in Bidcorp, and because of the situation where valuations were actually very, very attractive given the dynamics that I spoke about earlier, and we hedged that using a short position in Cisco, which is a US-based food services operator. So effectively, they do exactly the same things. They have very similar end markets, except Bidcorp had this very negative fundamental news cycle around it that allowed us to buy it at a very attractive valuation compared to Cisco. And as you can see, that long position in Bidcorp outperforming substantially that short position in Cisco, allowing us to make over 40% from this pair trade opportunity. Something else that we did is at the beginning of 2022, when we saw the interest rate cycle had turned, we were quite positive on South African banks. South African banks and most banks in general are positively geared to an increasing interest rate environment. But we didn't necessarily want to take on too much market exposure at the time, given that we were quite concerned about the market, and rightly so, given what you can see from the red line, which is the JSE's SWIX short. So we bought Nedbank and hedged it, going short the JSE index. And as you can see, in the process, enabled us to make 30% on this pair trade opportunity. Something else I'd like to take you through is where we actually make money going short specific shares. So I've got two examples which will take you through the fundamental bottom-up process that we took in deciding why we wanted to short a specific share. So the first example is EOH. Now, many of you will be aware of EOH because it was a very profitable or seemingly profitable business growing at extraordinary rates. And as you can see, the revenue compounded at over 21% and operating profit compounded at over 29%. And when that happens, clearly the share price also goes up. So the chart on the right, you can see the EOH share price. But we had always been quite cautious on the share because we knew that the acquisitive nature of the business model didn't necessarily always make sense. Essentially, the very high juiced up growth rates led the share price to be valued quite highly, and they were able to buy smaller, sometimes companies that weren't necessarily operating in the core market of IT services that EOH was all about. So we looked at the cash generation versus the earnings that they actually produced. And as you can see from the chart on the left-hand side, the reported earnings are the yellow line chart, and the red is the actual cash generation. And from 2014 to 2018, the total earnings were reported at over 3.7 billion rand versus actual cash generation of negative 343 million rand. So as you can see, we were very cautious of this, and understanding the market cycle is very important when you're a hedge fund manager as well. So we knew when the right time to short would be. And when investors started picking up this a little bit later, that's when we started shorting the share. As you can see there with the little yellow chart, yellow line on the chart, that's when we started building our short position, and clearly a very positive outcome for us, but not for the majority of or all of the EOH long shareholders. So really just showing you how we can do fundamental bottom-up analysis, really getting into the deepest or the deepest parts of the financial statements, doing our cash reconciliations, and understanding, are the reported earnings actually what's going on behind the scenes. The second short example that I'd like to take you through is Equitus. Now, Equitus started off as a very high quality property company. So essentially, they own logistics properties, and they also develop logistics properties, which are very attractive assets given how the world is shifting and economies are shifting towards logistics activities. Think about e-commerce, big distribution centers for retailers, where they previously used to work on physical stores. Now they're moving towards delivering to people at their homes or at their offices, which I'm sure you are all well aware of. So Equitus essentially focuses on owning and developing these logistics properties. Now, what started off as a very high quality business ended up being not so. So what happened was, in order to keep growing, Equitus focused on paying out dividends which weren't necessarily backed by the underlying cash from operating activities. And why did they do this? They did this because they needed to raise funds from the equity markets in order to keep growing. And the problem is, equity market participants always required higher dividend growth rates in order for it to be attractively valued to them. So this kept happening. And as you can see on the slide, this is a straight extract from the financial statements, 28 February 2022, where you can see that the cash generated from operations was 944 million, but the dividends paid were over 1.2 billion rand. So as you can see, you effectively overpaying on what you earn just to keep generating dividends to create this cycle for equity market investors. During this time, we'd built up quite a lot of knowledge about the underlying business model and the underlying reporting, accounting practices, which we thought were quite aggressive. So as you can see at the top, the reported distributable income was 1.265. That's effectively the amount that they're able to pay dividends out of, and the operating cash flow just under 800 million. So therefore, there's income that wasn't backed by cash of 465 million. Where did that come from? And when we actually looked at it, we saw that on these new developments, there was interest that they were paying to the debt holders that was simply being capitalized. So what that meant was the cash was flowing out the door, but from an earnings and accounting perspective, it was capitalized, meaning that it wasn't shown as an expense. Something else is that they also capitalized operating expenditure, meaning staff salaries working on the new developments, and even some of the staff that weren't necessarily directly involved, we saw them also capitalize over 116 million rand on effectively salaries, which should be expensed and is a real negative cash flow event that you shouldn't be paying out. And interest on cross-currency interest rate swaps, which is a practice of essentially financial engineering that a lot of property companies have done. So we think that effectively, although you've got a fairly high quality property base, you're paying a lot of your dividends out of the tree, as opposed to generating fruit and just paying that out as dividends. And this impairs the ability to generate fruit over the long term. So as you can see, the Equitus share price from almost at 24 Rand at the beginning of 2022 to now just under 12 Rand. And that's been a fantastic short for us. Let's talk a little bit about our hedge funds. Now, this is quite an interesting chart. It shows the multi-asset low, high, and pure equity categories in South Africa, and a number of funds, pretty much all that you would recognize, shown by those small dots. It's quite interesting. This is a 10-year chart, and as you can see, a general trend that you would expect is a lot higher return towards the right-hand side of the chart because you're taking on a lot more risk. And you can see that risk is shown by the variability in nature of those scatter or those dots, and also by the fact that the bottom axis effectively shows risk. And you weren't necessarily being compensated by taking higher risk in that environment. But something that's very key in this slide is where our two funds place: the Peregrine Capital Pure Hedge Fund and the High Growth Fund, which, as you can see, both from a risk and a return perspective, significantly beating almost all of our peers, and really showing true outlier status amongst the last 10 years. If we look at diversification, we really think about being diversified, not for the sake of being diversified, but for when it matters. So this chart shows every month where the market return was negative, being the JSE All Capped SWIX, and that's shown in yellow. And the blue chart, or the blue bars, are the Peregrine Capital High Growth Fund. And as you can see there, if we take an average return of all of those months where the JSE was negative, the Pure Hedge Fund, on average, was actually up 1.2, the High Growth Fund actually up 0.52, and the JSE Capped SWIX negative 3.32%. So during those months where the rest of your portfolios, or portfolios that were heavily exposed to the JSE equity indexes, our funds really added significant value to our investors' portfolios. Let's talk a little bit about correlation, because I think this is absolutely vital when you're building a portfolio. You can see those scatter plots and those dots across the same multi-asset low, high, and equity general categories. Now, there is a very high correlation, especially in the South African market, where the number of shares is not significant like you would see in other global markets. And as you can see, once again, we are outliers, with the Peregrine Capital High Growth Fund, the green dot, being just over 20% correlated to the JSE, and the Pure Hedge Fund actually negatively correlated to the JSE. And when you combine this correlation to the returns. You're not giving up any returns, but you are able to add these two portfolios to your overall investors' portfolios and add significant amount of return potential with reduced risk because of this perspective. And I think correlation is really one of those understated things, as I mentioned, specifically in the South African market, where you can see the number of other managers being over 80 or 90% correlated to each other. So it really doesn't matter which portfolio manager you choose. In the same kind of environment, you'd expect a very similar return and risk profile. What we've done here is we've shown on the top a portfolio of a balanced fund, which is effectively just 60% equities, 40% bonds, and our hedge fund, which is split between 50% in our pure hedge fund and 50% in our high growth fund. So just keeping it very simple. Now those top bubbles show a portfolio with 100% balanced and 0% hedge, all the way through to 30% in that balanced portfolio and 70% hedge. And the outcomes on the top are the total 10-year returns that you would have had in those various splits. And as you can see there, with the portfolio that is 100% balanced and 0% hedge, the return was just over 100%, whereas the portfolio on the right-hand side, the dark blue dot, with 70% in hedge and 30% in balanced, over 200% return, a total return increase of 91% by using the 30% balanced, 70% hedge versus zero hedge. And as you can see across the range, the more hedge you had in your portfolio, the better return dynamics. And the same can be said for maximum drawdowns. We really like to give investors a feel for what our drawdowns are, because that sometimes is a very true reflection of volatility and risk that we take into the portfolio. And as you can see, even though your returns have increased, in that same 100% balanced, 0% hedge portfolio, your maximum drawdowns were almost 20% on the left-hand side, that's shown by the dark red dot, and the blue dot on the right-hand side with 30% balanced and 70% hedge, a maximum drawdown decrease of 60% being just over negative 6% that you would have had as your maximum drawdown over the last 10 years. So really showing its true value by adding hedge to your clients' portfolios. I'd like to go through some key takeaways from today's presentation. We have an exceptional track record. We've proven over a number of market cycles and over 25 years that we're able to deal with pretty much anything that the market has thrown at us during that time. We've also proven to have true diversification with downside protection and low correlation. And I think this is quite key when you're building your investors' portfolios, to take into account not only returns, but also risk. And our funds have managed to really boost both returns and risk. Thank you very much for listening to my presentation, and I hope to chat to you soon.